Hello and welcome to another episode of the Uranium Market Minute. My name is Justin Hune. I am your host. I'm the founder and publisher of the Uranium Insider Pro newsletter, the only investing newsletter that focuses solely on uranium and publishes on a regular monthly basis. Thank you so much for tuning in. Today is Wednesday, November 3rd. This is episode 30th episode. I've really been enjoying doing these videos, and I hope that you all are appreciating the content. I thank you for all the great comments of support below all the videos. Thank you for all the love on Twitter. Just really appreciate this community very, very much. And if you have been enjoying this content, if you like this video, subscribe to this channel, hit the notification bell. You will be reminded and notified whenever we update and publish a new episode, which is almost every day. Before we get into the content, as always, nothing in this video is intended to be investing advice. I am not your financial advisor, despite what some of you are commenting on below the videos saying, thanks for being my financial advisor. Yeah, that's not me. And nothing here is financial advice. Always do your own due diligence when it comes to investing. Always take responsibility for your own choices. Let's jump right into the daily scoreboard here. The spot price of uranium down again today, 41.75 mid-market. The price continues to fall, though it's primarily on very low volume and just a lack of demand in the spot market over the past week or so has pushed these prices down. As we've seen repeatedly now, it seems that traders and perhaps other entities are taking advantage of whenever the Sprott Physical Uranium Trust is not very heavily in the market or not in the market at all. When they're trading at a discount to NAV, at the very least, they're not raising cash. So if they're not sitting a lot of cash, then they likely are not doing a lot of purchasing in the market. And so we've seen, and this is going to be the case going forward, in my opinion, as we've seen this happen 3 times now, essentially. When Sprott's active, the market is moving up for the most part, especially when there's big volume coming into that trust. And when they're inactive, the powers that be and the traders essentially are taking advantage of that and are moving the price down. This is just going to this is how it's going to be going forward. It's going to be a very volatile market, and we can expect these higher highs, higher lows. That is how the market is going to move going forward, in my opinion. The Sprott Physical Uranium Trust yesterday took in a very small amount of capital, 1.15 million in new capital. They did slip back to a discount to NAV at yesterday's close at just a 0.28% discount to NAV. However, as you're going to see shortly, big moves in the trust today in the market. They are definitely at a premium to NAV at this point, especially with the spot price moving down today. So more than likely, they have issued a healthy amount of shares in the market. In my opinion, they probably raised at least 40 to 50 million today. We're going to see in a couple of hours when they report. They did not purchase any pounds of uranium yesterday either. And they ended the day with 16 million in cash. And again, to sum it up, since their ATM went live on August 17th, and again, ATM at the market, this is their financing vehicle that allows them to issue shares into the open market. Whenever they're trading at a greater than 1% premium to NAV, they can issue shares into the market. They're willing to issue up to 50 to 60% of the daily trading volume. So if they're at a premium to NAV, more than 1%, and the volume is heavy, they will be issuing a lot of shares into the market to raise cash to buy more physical. That's the whole idea. So since the 17th of August, they've raised 746.3 million in capital and have acquired just over 16.9 million total pounds of U3O8. Turning to the sector ETFs, yesterday, or this morning, actually, URA reported 170,000 shares of redemptions. That's in outstanding shares. URNM, no change. So URA's redemptions gave rise to a mandated sector selling of 3.2 million. Not a lot, but it's something, right? And that reflected in the kind of blasé market yesterday and the day before, Monday and Tuesday, November 1st and 2nd. The assets under management of the two trusts combined fell a bit, decreasing 16 million. The AUM combined total between these two still stands at just over 2.1 billion. And after today's trading, as you'll see in just a second here, that's probably north of 2.3 billion after today. Let's go ahead and take a look at the charts. Starting off, as we usually do, with URA, the Global X Uranium ETF, huge day for URA, up 7% on very, very good volume. This is exactly what we're looking for. Remember, I've mentioned this ad nauseum, repeated in these episodes. If you're watching this for the first time, what we're looking for in a bull market is big volumes, increasing volumes on the way up decreasing volumes on the way down. And we see that over and over, up and down, increasing, decreasing. Now, very big volume coming into URA with a huge green, beautiful candle here. I would like to see and would probably expect to see some follow through, if not tomorrow, on Friday. This is going to be a monstrous weekly candle for the Global X Uranium ETF. URNM, huge volume, very big green candle, just absolutely loving this action here, you guys. The Sprott Physical Uranium Trust, record daily trading volume today. I mentioned this on Twitter. I called it in the morning after I saw the first hour of trading. And, you know, to be honest, it wasn't a difficult call. But I didn't, as the day went on, I was kind of like, maybe it's not going to be a record. And the last 45 minutes, they came in pretty hard. Big volume, a nice up day. U.UN up 4.17% on the day on very big volume. So we can expect that this resulted in a large share issuance, a lot of capital raised today, most likely, which means they will be in the market buying uranium very shortly. We will see the spot price start to move up again, and we will see that multiple effect, that second order effect, flywheel effect happen, because not only the ETFs buying the underlying holdings, but the Sprott Physical Uranium Trust buying physical uranium, having an effect on the equities as well. We've got a double flywheel here. And this is a big one because that actually equates to less pounds in the market, a short-term push up in the spot price of uranium, and a long-term support of the increasing supply deficit relative to demand. Cameco had a really big day as well. Big volume, very big upside here. Bank of America released an updated price target for Cameco for CCJ. They are calling for $40 in 12 months. That's what is that? That's 50%, almost a 50% rise they're calling from these levels for Cameco in the next 12 months. And they're calling for 60 plus a pound in spot price of uranium over that same time period. These are big numbers. Usually these analysts are pretty conservative. So to see that, that's really saying something. Let's take a look at the mailbag. This question comes from John Kohler in the YouTube comments. Hi, Justin. Can you address the issue of who will actually be producing uranium in the 2022 to 2024 timeframe? I'm finding out that most of the stocks will not have uranium to sell anytime in that timeframe. If there's a huge price spike, for example, those companies that have uranium to sell at that price will benefit the most. I realize there could be long-term contracts signed for future production, but if I were a buyer, I would tend to favor an actual current producer. What can you tell us about this? Thanks. That's a really good question, John. So you're correct, essentially, that most of the companies in the space will never produce a single dollar of revenue. And as I've mentioned before, not only to newsletter subscribers, which was really hammered home in the previous month's newsletters, but also I've mentioned multiple times in this podcast that this investment thesis has fantastic underlying fundamentals when it comes to supply and demand, when it comes to a growth sector, when it comes to sentiment turning positive. But it also has a flow of funds story. And this is kind of essentially the story for the stock market in general across multiple sectors. And you can take a look at Tesla, for example, right? We have this one car company that has a larger market capitalization than all other car companies combined currently. Does that make sense on paper? Does that make sense relative to their profits? Does it make sense to any form of discounted cash flow? No, it doesn't. But it's a flow of funds story. As the funds flow into that vehicle, the stock is just going to keep moving. And that's what we're seeing here. And so while your question is pointed and you're essentially correct that most companies won't be producing, it's not necessarily the current producers whose underlying stock will move the most, because there basically are no current producers, right? There's Kazatomprom that are publicly traded. There's Kazatomprom, there's Cameco. URG produced a tiny amount in the States last year, and probably this year, maybe just a few 100,000 pounds. And there's not many other producers, right? So really what we're betting on when it comes to our investments, and I'll speak specifically about the newsletter, okay? And the recommendations that we have made and that have vastly outperformed the market, are that we're looking for companies that have individual company catalysts, so that even if the sector doesn't move in the way that we expect, that these companies individually will outperform. And when the sector moves as we expect, these companies will do even better than the competition. We also like companies that we believe will get into production during this cycle. There's something in the messaging to the market about a apt and capable management company that can actually bring a project into production. This is no easy task. And the expected revenue from that future production is not really what we're baking into the thesis. I understand that traditional value fundamentals, value investing fundamentals and analysis tools such as discounted cash flow analysis, while they may represent a relative value to peers, let's say, they don't represent a logical explanation of what sort of valuations we are to expect in this bull market. And so you can take a company like Cameco, for example, who is a producer and is going to be one of the first movers when it comes to signing long-term contracts. If you think that Cameco is going to outperform some of the small and mid caps just because they're producing uranium, I think that you're misinformed. And it has much more to do with the free float of the stock, with the share structure of the stock, with the starting out market capitalization, with the percent holding of that equity in the ETFs relative to the free float of the stock. All of these things take this into account. And Cameco sort of has its expectations baked in a way, right? We all know what they produce. We all know what they will produce when they bring their care and maintenance mines back online, primarily McArthur River. Now, they may throw in some surprises. I think the stock will jump to the upside if and when they figure out the CRA tax deal and get that cash back. That would be a huge boon for the company. Maybe they'll make some M&A deals. Maybe they'll do a bit of exploration. We don't really know. But for the most part, the story is kind of out there and understood for Cameco. We really like the companies where the story is still being written. And those are the companies that have really done well for us, is the companies that have surprised the market with developments. So that's a really, really great question, John, and I appreciate you asking. But of course, we believe that the companies are those that are going to grow with new developments during the bull market, especially if they start out as a mid cap or a small cap. The upside potential is so much greater. With that said, the large cap producers are doing fantastic and will do well. You always get more leverage with the smaller caps. I mentioned yesterday about some options trades that we have structured that have performed extremely well, that they've 3x outperformed the underlying equity, the common stock of the option trade. And that I would touch on that structuring of those trades briefly right now. I will say that when we do issue these trades as trade alerts to our newsletter, we go deep into the details of exactly what we're doing and instruct our members on how to structure these trades through their own brokerages, okay? And so it's complicated trades if you don't understand options at all, but they're essentially very simple. Okay, so while we have taken on some leaps, some long dated call options, we have done that in the past with really good success. The options trades that we've structured that we're currently in right now are bullish vertical call spreads. And so what this essentially is it's a single trade. So you don't want to do these individually as far as buying the in the money call, selling the out of the money call. They happen simultaneously within what's called a bullish vertical call spread. And you can structure these with your broker. You can literally pick up the phone and do this. What it does is by selling the out of the money call, you are not only protecting your downside, so especially in the short term, right? If you are directionally wrong, at least for part of the trade, you can be as much as 10% down on the common stock underlying and break even on the trade, okay? So it protects your downside. It also limits the cost of the contract because selling the out of the money calls reduces the overall cost of buying those in the money calls. We've done this twice this year, and these trades are absolutely printing cash. And so, as I mentioned, this is something that we're going to be doing repeatedly. And while these options trades make up a relatively small percentage of our portfolio, we're mostly long common equities. They do add fantastic alpha to the overall market. And it's been a really big benefit for us, for our members. Like I said, we go over these in detail whenever we issue these. And I also wanted to clarify something from yesterday's episode where I mentioned that we are going to be raising our prices by $200 on December 1st. Had a bunch of existing members reach out asking what that meant for them. And if you are already a member, whatever price you paid for your annual membership, that price is locked in for as long as you want to renew whenever that year is up. Okay, so no worries. If you're already a member, that price is locked in for as long as you want to be a Uranium Insider Pro member. If you are considering it, if you join before December 1st, the current price of the newsletter, you will also have that locked in for life. So just wanted to clarify that for everybody. And as I always mention, if you're interested in getting a sample newsletter, please send us an email, support@uraniuminsider.com. We'll send you a previous month's newsletter to check out the type of content that we put out on a monthly basis. With all of that said, officially, we are in day one of the next leg up for this uranium bull market. The ETFs are on high volume. The Sprott Physical Uranium Trust is a record volume. The spot price will be moving, if not tomorrow, very soon. And the equities are discounting the future. They're discounting mechanisms, as always. And whenever you see the miners move before the metal, we see this frequently in precious metals and other commodities trades, although we haven't seen that very much in precious metals over the past year or so. Whenever you see the miners start to move, they know something's coming. They're kind of sniffing out what they expect to happen. And that is not really a great mystery at this point. When you see volumes come into the Sprott vehicle, you know what's going to happen, and that's happening soon. So hopefully you all bought that dip on Sunday. I sent out the weekly watch list to our members, and I stated verbatim, look for dip buying opportunities the first few days of this week. I hope that our members listened to that if they were and are still positioning. If anyone is waiting for confirmation that the next leg is happening, today was your confirmation. Why do I typically buy on weakness and not wait for that confirmation? Because you see the types of moves. See the types of moves that these things make. 5, 10, 15% in a single day on day one of the reversal of the trade. It's very difficult to miss those. So when things are falling on low volume, 1, 2, 3% a day, and you kind of nibble away at them, you're positioned by the time they move back the other direction, and they move hard when they do. All right, very good. Thank you so much for tuning in again. I really appreciate everybody. Have a great night. We'll see you tomorrow. Cheers.